Good. Uh, well, thank you, Dean, for being here. Welcome to our first monthly fixed income webinar series. We want to be respectful of your time, and that's why we will be succinct and as informative as possible with a Q&A at the end. As a side note, we're always available for calls anytime as we view our partners as investors and investors as partners. I'm George Lukács, partner and head of global distribution, and with me is Dean Smith, partner and chief investment strategist. The partners at Folio Beyond have a decades-long track record and have been active participants in the fixed income world. We're launching these monthly webinar sessions because we believe fixed income will play an increasingly prominent role in portfolios over the next several years. A brief note about Folio Beyond: we launched in 2017 as a fixed income boutique providing fixed income solutions and proprietary fixed income model portfolios for portfolio managers, and have launched 2 actively managed ETF, RISR and FIXP. And we're pleased to share our insights with you today. So, Dean, let me start with the big picture so we can understand what's been happening here in the increasingly important sector, which is fixed income. What were the main highlights in the bond markets throughout 2025?
Well, thanks, George. Obviously, it's been an interesting year. A lot of policy volatility, might even call it chaotic. I would say the most important aspect of 2025, however, was the persistence of inflation significantly above the Federal Reserve's stated 2% target. We could talk some more about sort of why that is, but that is a reality that the market is coming to terms with. We seem to be sort of stuck in this somewhere between 2.5%, edging towards 3% inflation, and it doesn't really seem to be coming down. I mean, you can pick your statistics and so forth, but we're definitely not hitting the Fed's 2% target, and I don't think we're going to hit it this year either. We'll talk some more about that. What are the reasons for that? Tariffs. I can't remember a more chaotic day in the market, certainly since the financial crisis of 2008. I can't remember a more chaotic day than Liberation Day on April 4th of this year, when the worldwide tariffs were announced, and anybody who could add, subtract, multiply, and divide was just shaking their head saying, what in the world is going on with these tariff rates? And the rollout was so extremely distressing. I mean, the market really took a header, and it wasn't until the 7th of April when they came around and said, well, maybe we didn't handle that all that well, we're going to kind of back off a little bit. The market recovered, but the tariff chaos has continued. New tariffs announced, regularly, levied for reasons unrelated to trade, for, geopolitical reasons, for sometimes what seems like petty reasons. We now have, everybody's waiting for the Federal Reserve to see where they're going to rule on the broad-based, i.e. EPA tariffs. But even if they rule against those, tariffs are not going to go away. So that's something we're going to be living with for a while. We can talk some more again later about why that might be.
I think that's something that's been interesting to people as far as when these price increases, and they have come. But don't you think, Dean, that there's been a lot of the wholesalers who have kind of eaten these tariffs for a while?
Yeah, there was a study that came out a couple of weeks ago. I'm trying to remember who published it, but it doesn't really matter. It's very difficult to actually compute who's paying the tariffs. As a checkbook matter, the party that takes the goods at the port technically pays it, but how much of that gets passed on down the line? And it has been definitely a case where the earlier stages, the intermediate stages of the supply chain have been absorbing a lot of that tariff, not passing it through, kind of waiting to see how this is all going to play out. Over the course of the year, as it became clear the tariffs were not going to go away very quickly, more and more of that tariff was being passed through to the end users, and you had companies like Walmart and some other retailers saying that they were going to start marking up their goods to reflect more of that tariff hitting them at the end of the supply chain. So, some allocation between end consumers and the immediate parties in the supply chain were taking it, but it's being paid by Americans. Foreign countries are not paying these tariffs. It is hitting U.S. businesses and households, and that's just the fact, no matter how you try to spin it. Americans are paying these tariffs.
There's no doubt about it. But let's moving on to something that people have been writing about, maybe not enough until recently. Some of the credit spreads that have literally got as tight as I can remember, Dean, over the last 2 years, year and a half. What does that trend mean to you as far as the credit spread tightening? And is this something that's going to bounce back? Is it going to blow out at some point?
Well, the economy, on just like if you measure it in terms of GDP growth, has been doing pretty well. We can talk about the labor market a little bit, but just in terms of the top line growth and business profits and increasing sales have been pretty good. And so that hasn't really been a drag at all on the economy. Now, the labor market is a little bit different story. The hire fire numbers have all been very much depressed, but there's a lot going on behind the scenes there. You've got a massive amount of deportation of illegal, undocumented, however you want to refer to it, who've gone back to their home countries, or at least back across the southern border. By some counts, maybe as much as 2 million. And that's over and above the 750 or 800,000 deportees that the government has caused to happen. So you've had a lot of dislocation in the labor market, and that is showing up in things like construction. It's showing up in things like agriculture. It's showing up in hospitality. But the biggest decline in employment in 2025 is actually coming from the government sector. That's both federal as well as state and local. The federal government in particular has lost almost 700,000 jobs in 2025. And those aren't going to get added back. And see, this is one of the other disconnects that people maybe aren't always making. The Federal Reserve can cut short-term rates, but that isn't going to have any impact on whether the government hires or fires employees. And it's certainly not going to affect whether people from Latin America come back across the border to work in construction and agriculture. So we're going to see some stresses in the labor market throughout the rest of 2026. Having said that, we're still at a 4.4-ish kind of unemployment rate, and that is, by all historical measures, full employment. So the story about the real economy, jobs, profits, growth is actually still a pretty good one as historical comparisons go.
Yeah, you brought up the Fed cutting rates. Well, the Fed cut rates 3 times last year, and we
7 in the last 2 years.
Yeah, and we really haven't seen long-term rates fall as many expected. Can you explain the disconnect on what it might signal for the future?
Yeah, I'm going to try to share my screen here. I've got a chart here that I think is pretty remarkable. Let's see if we can do this.
Beautiful, I see it. Yeah.
You see that? Yeah, so the dashed line is the yield curve from all the way, up to 1 month out to 30 plus years. The dashed line is where it stood at the end of 2024. And as we see over the course of the year 2025, big declines in the short-term rate. Okay, this is the rates where the Fed has the most direct influence on the market rates of interest through the Fed funds, and that cascades out into T-bills and so forth. But if you go out to 10, 15, and 30-year, the yield curve has steepened substantially, okay? And so the distress that is coming out of the White House and some other folks about, why aren't interest rates lower? They are a lot lower, but not in the longer end of the yield curve where it really matters. Out here is where companies borrow to build plant and equipment. Out here is where mortgage rates are set. And so the steepening of this yield curve has been probably, from a market perspective, the most significant and, to some folks, most troubling or confusing part of the story. But in reality, this is kind of not that atypical. I mean, people expect if the Fed cuts rates, all interest rates are going to go down. Historically, that's not what happens.
Yeah, that's a very revealing chart there as far as what the term premium is expected to mean for us going forward. Is the term premium enough as far as a 10-year is concerned and 30-year, or is it something that we see possibly moving incrementally higher over the next couple of years?
Well, here's the reality. We mentioned it a few minutes ago. The Federal Reserve's official inflation target is 2%. They have been sort of slowly backing away from that number rhetorically and otherwise for a while. The shadow number, the whisper number, if you want to call it that, is actually 3%. And they have made statements, Jay Powell, as well as some other members of the Fed, have made statements along the lines of, we're going to get to 2% sort of over time, gradually, as long as inflation expectations stay well anchored, we'll get there. But, maybe not right away. The real numbers for their inflation target is 3%, and it may slip even higher. When that gets fully baked into the market psychology, you could very well see the 10-year and out go a bit higher. I don't think we're going to see, the super high rates that we saw, during the Biden administration before the Fed started cutting, but we're not going back to the 2 and 3% rates that we saw during the financial repression days. And there's a number of reasons for it. I'll share you another little chart that I thought was pretty interesting. This right here. Okay, that is a chart over time of the Federal Reserve's balance sheet, mostly Treasury bills, Treasury bonds, and a lot of mortgage-backed securities. So for the longest time, it hung down here around $1 trillion or so. After the financial crisis, it took a jump up to about $2 trillion as they exercised those extraordinary measures to kind of keep things from completely falling apart. And then for some inexplicable reason, it just continued to climb. By 2020, prior to COVID, it already reached $4 trillion. Then with COVID, it takes a jump up to $7 trillion, ultimately peaking at almost $9 trillion. This is a 9-fold increase in the amount of the Fed's balance sheet. Now, what's the opposite side of the Fed's balance sheet? Money supply. When the Fed buys bonds, it takes bonds out of the market and puts dollars into the market. This declined to around 6 and change. They've already said they're going to stop running off the balance sheet. This is a long-term mega trend, if you will, that is going to be part of the inflation and higher interest rate picture for quite some time to come. We're in a different regime than we were prior to, say, 2010. We're in a different world, and people need to get used to it.
Which brings us to another topic near and dear to all of our hearts, the housing market, and how that's affecting not only the consumer, but the consumer sentiment, which I think I just saw was one of the lowest in a decade that came out about 10 minutes ago.
Yeah, housing is a real problem for this country, economically, socially. The housing affordability crisis has been growing for a long time, Again, not to keep bashing the administration, but they tried to, downplay it, poo-poo it, saying it wasn't really a thing until the last several months, perhaps. But one more chart, if I could. This is a picture of housing affordability over time. Now, the blue line, this goes back, 20 years or so. The blue line is housing prices. And this was the peak of the financial crisis. It came down. Here's what's happened since then. Just an explosion in the housing prices that have taken them out of range for many, many people. This white line is an index that measures housing affordability. So it looks at the monthly payment compared to monthly incomes. We are near record lows in housing affordability, and it's not rates. If the mortgage rate right now is running right around 6%, if that went to 5%, that's not going to really move this needle that much. It's all about housing prices. And the reason that housing prices are so high is we have a massive shortage of housing. The ideas that have been floated out there for 50-year mortgages or making mortgages portable, or none of that's going to matter. First of all, if you start messing with this mortgage structure, you're going to take Fannie and Freddie and Ginnie Mae out of the picture because they are limited by statute to the kinds of mortgages that they can guarantee. So that's not something that is an easy fix. What really has to happen is we have to build a lot more homes. We have a several million household home shortage versus the number of households that we have in this country. And the only thing that's going to fix that is building a lot more homes. A lot of the homes we have are in the wrong places. They're in places like Michigan, they're in New York, they're in Wisconsin. We need houses in North Carolina, we need houses in South Carolina and in Texas and other places like that where the population is moving. So this is an extremely complex problem that's not going to go away anytime really soon. I hate to be the bearer of bad news with respect to inflation, with respect to interest rates, and with respect to housing, but this is the reality that fixed income investors need to be coping with and hoping that we're going to go back to 0% interest rates or 1 or 2% interest rates as the way as the president has suggested they ought to be. It's not going to happen.
Yeah. Well, there's a growing talk of radical restructuring of the Treasury's debt. I mean, with interest payments reaching, I think, $970 billion last year in 2025 and projected to hit up to $1.8 trillion in the early 2030s. What does this mean for investors in 10-year and longer-term bonds? I mean, some have proposed forcing holders to swap current bonds into ultra-long 50 to 100-year securities at lower rates. That, I think, would be probably considered by many to be a soft default.
Yeah, I'd say it's at least a soft default. A lot of the holders of Treasury securities globally are foreign central banks and foreign banks and sovereign wealth funds and all sorts of things like that. It's kind of hard to see them upsetting the global financial apple cart quite to that extent. But they, are going to need to do something because they simply cannot afford to cover the interest burden right now. The president has suggested a 50% increase in defense spending over the next little stretch of time. We've got Medicare, Medicaid, and Social Security that are literally going broke in the next, 5, possibly, maybe certainly more than 10 years. The fiscal situation is grim. And what they're going to do about it is anybody's guess at this point. But, the U.S. is no longer rated AAA. And that's a recognition of the fact that it's no longer can be considered a risk-free asset. It's still very creditworthy, but the tenor the market has changed and people are starting to question, they're starting to diversify, they're starting to move out of dollars. Not wholesale, because there's not too many other places you can go, but on the margin. And remember, prices are set on the margin. It doesn't take a big move, divestment in treasuries and other dollar-denominated assets to cause interest rates to continue to have upward pressure.
Yeah. Well, given everything we've discussed, we're obviously very cognizant of your time as a viewer here, but everything we've discussed today, as well as using tariffs as a policy hammer, unhitched federal deficits, the investigation of our Fed chairman, the Greenland debate, there are many reasons to view bullion as the really safe haven. And by certainly in my career, I've never seen this kind of movement in silver and gold over the last month, 2 months. But let's talk about other practical solutions. I mean, certainly there's enough advisors who will tell you to keep a certain portion in gold. But this is something that maybe we can talk about briefly, what we brought to the market.
Sure.
And we developed our ETFs, RISR and FIXP, to provide diversification and really reduced fixed income duration in what is best called a challenging environment. Maybe we can talk about a little bit about RISR as well as FIXP. And what are the benefits of these strategies?
Right. We've been telling investors for a long time that they should. This is a risk management. This is a play defense kind of environment. What you want to do is you want to reduce the volatility of your holdings, and you want to generate current income. The great thing about income is that it comes in every month and it compounds, and it really provides a lot of cushion to a fixed income portfolio, or any portfolio for that matter. So what our first ETF we launched in 2021, RISR, does is invests in a particular type of mortgage-backed security called interest-only mortgage-backed securities. And what they do is the portfolio generates a current income of around 6% dividend yield. But the really interesting thing is that these mortgage-backed bonds go up in value when the rest of the fixed income marketplace is going down in value. So as interest rates rise, our RISR holdings tend to rise as well. So you get an offset. It's got a negative about 35% correlation to the broad bond market. So if you own bonds and you want to manage risk down, reduce your volatility, reduce your so-called duration, having RISR, or if there's anything else quite like it, I don't really think there is, but having an allocation to that strategy, we think, just makes a lot of sense, even if you don't think that interest rates are going to go much higher from here. It just helps to modify the total risk profile of your portfolio while not giving up any real income. So that's a strategy that we think makes sense for a lot of fixed income investors.
Yeah, and we launched RISR October 1st, 2021, and I think what investors are seeing right now is the diversification benefits, as you said, the reducing of the fixed income duration. Correlations are near zero with both equities and fixed income in general. So I think that's something that we believe is more than an alternative. It's become kind of a cornerstone of many of the RIAs we've talked to of their portfolio.
Yeah.
So that's kind of the takeaway we want to talk about. Dean, should we start the Q&A?
We also should mention the FIXP, which is FIXP. That's another ETF that we offer that dynamically allocates across the entire fixed income spectrum, from corporates to govies to municipals to mortgages, real estate, everything. And that is one where, a lot of people with their fixed income, they have kind of static portfolios. They don't tend to manage them as actively. This is a strategy that takes the guesswork out of dynamic allocation across the fixed income space. So for people who want to have the benefit of a diversified fixed income portfolio but don't really have the time, inclination, interest to do their own dynamic allocation, a strategy like FIXP can be really helpful. But so if people do have questions, you can put them in the chat. It's should be on the right hand side of your screen. This is we're here to answer your questions and address your concerns. So anything you have, pop it in there, and if not, we'll give people a minute or two. But yeah.
See if anything's come in.
Yeah, doesn't look like it. Maybe we covered everything so thoroughly they don't have any questions at all.
Oh.
That's always a possibility. Here we go.
Yeah, we got a couple questions.
Let's see. How can policymakers stimulate home building? Well, this is a really interesting question because it's really not very much in the hands of the federal government. What's impeding home building is local rules about zoning and building codes and permitting, and in some cases, not climate, but ecology and habitats and things like that. It's very difficult. I mean, I think that if you look at the homes that were destroyed in the fires in the coastal California last year, I think they've only started on one or two homes. I mean, the permitting is really quite difficult. So there needs to be, I would say, almost like a Manhattan Project where you get governors together and get them to agree that this is a problem and try to find ways to spur construction and housing development. So,
yeah, certainly not going to
yeah.
from job owning, interest rates to go further down, because that's
as I showed in the chart earlier, it's not about interest rates. If you cut mortgage rates are already at really tight levels relative to risk-free rates. Okay, the so-called mortgage spread is very tight. So mortgage rates are not that much above Treasury rates compared to historical norms. And if you push even if the 10-year went down by another 100 basis points, mortgage rates probably wouldn't. Mortgage spreads tend to widen as rates decline, and so pushing on rates isn't going to fix this problem. No.
Which brings us
well,
to
we're
the
at
next
11:30, so thank you
also,
very much. Yeah.
One more question.
I guess we can do one more question. Yeah.
Yeah, we all see how historically tight credit spreads are. What would happen to RISR if these spreads widen considerably?
Yeah, again, as we were just discussing, mortgage spreads are at very tight levels. If mortgage spreads and other credit spreads were to widen from here, which we think that's kind of the only direction they can go, to be honest, what that means is that prepayment rates will slow down. People will become even less able to refinance their existing mortgages or pay off those mortgages, and that's actually good for RISR, because the slower the rate of repayment and housing turnover is, the better RISR performs.
Well, that's great. Well, thank you. We made it 11:31. Again, we wanted to be very mindful of your time. We didn't want this to run an hour. We had a Q&A. This is the first of what we hope to have a monthly webinar on fixed income. We want to thank the participants, and we will continue to email those who have attended to see if we can continue the monthly webinars, which we will. Thank you, and thank you, Dean.
Thank you, George.